Our objective today is to give you our thoughts on the handful of topics we've been discussing most frequently. As always, we'll do our best to make the discussion as data-driven as possible and remove as much emotion as we can from our ideas and thoughts. Before we jump in, we want to give you some tips to maximize your viewing pleasure today. First of all, within your Zoom window, if you'll click on the view icon in the upper right-hand corner of your screen, we've got a screenshot on the page here to kind of give you an idea of what that looks like. Second, at the top of the menu, please make sure that standard is selected and has a check mark next to it. And then finally, at the bottom of the menu, if it says exit full screen, then you're fine and you're ready to go. If it says full screen, please click on it. That'll make our window full screen and give you the ability to see it as best as possible. As far as asking questions today, to limit background noise, we've got everyone's line muted, but we want to encourage questions. So just as we've done in previous webinars, to ask questions, please do so through the chat bar. And you'll find the chat bar at the bottom of the window. So if you run your mouse over the bottom of the screen and you click on the chat icon in the bottom, it'll allow you to go ahead and type in your question. Your question will only come to us, so no one else will see it. So it'll be an anonymous question as far as the other participants are concerned. Please feel free to type in your question as we go so we don't forget it. And we've got a couple of points throughout the discussion today where we will stop and take questions, but feel free to enter them as they come up. Quick disclosure, we'll be discussing past performance today at different times throughout the presentation. So this is just a reminder that past performance is no guarantee of future results. Our agenda today covers the most common questions we've been hearing from clients recently. Today's discussion really gives us the opportunity to share with you the research and data we've found on the topics that we've been discussing most frequently and how it informs our advice and guidance to clients. We want to encourage questions, so please remember to enter your questions in the chat feature at the bottom of your screen. But before we get started into the material, I wanted to give you an update on our team. You're going to be hearing today from 4 of us on our advisory team, myself, as well as Katie Dow, Lavia Thomas, and James Smith, who are 3 other members of our advisory team. And I'm excited to let you know that we've added 2 new members to our team this summer. The first is Nate Berman. Nate joined us this summer as an operations associate, where he'll be working with Bryn and Rachel on our operations team. And his real focus is going to be on trading, portfolio management, and cash management. Just an FYI, you may hear from Nate from time to time in the future, as he'll be taking on much of the cash management responsibilities from Rachel and Bryn. Nate's also the first member of our team to take and pass level 1 of the CFA exam. CFA is the Chartered Financial Analyst designation in our industry. It is really the highest designation in our industry for analysts, financial analysts. And it's really akin to the CPA exam or the bar exam in the accounting and legal fields. A couple of quick fun facts about Nate. Nate hails from the great state of Wyoming, and Nate was a college basketball player. So if you run into Nate at any time, he's always happy to talk hoops. The second member of our team that joined us this summer is Trevor Hotmer. Trevor joined us as a summer associate supporting our advisory team. Trevor is entering his senior year at Boise State University, where he's pursuing a degree in finance. And unlike Nate, who spent his winters in cold Wyoming, Trevor grew up in sunny Southern California. We've really enjoyed having both of these guys join our team this summer. So if you have any interaction with them in the coming months, please welcome them to our team. And with that, James, I'd like to turn it over to you. I want to introduce you to James Smith, a member of our advisory team, and James is going to talk a little bit about the history of market volatility.
Thanks, Mike. To kick us off today, I'm going to talk, like you said, about the history of market downturns and dive into some of the historical data on market downturns in both the equity and bond markets. First, though, let's talk a little bit about this year, 2022. We've seen a lot of volatility. We've seen significant volatility across all major asset classes. And during times like this, it can be easy to feel a little bit uneasy as an investor. And maybe your portfolios felt a little bit like this. This is Mike and Livia's girls feeling some volatility themselves. And so 2022 has been a bumpy ride. And I think a reasonable question that you might ask yourself today would be, is this volatility that we're seeing in the market, is it normal? How is it compared to historical numbers, and what might I expect going forward? So if we look to the past, we can get a pretty good idea for how frequently we do see market volatility and to what degree. And so as we look to this chart, this shows US stock market data measured by the S&P. And so if we look at the bottom of this chart on the horizontal axis, then we can see the years from 1980 to 2022. On the left side of the chart, we see the returns, both positive and negative. And I want you to focus specifically on the gray bars. So the gray bars are showing us the calendar year returns. Calendar year return, meaning this is the return of the period from January 1st to December 31st. And it's really just where we ended up at the year. Compared to the red dots that you see, you'll notice that all of the red dots are actually negative. The red dots are what we refer to as the intra-year decline. And the intra-year decline, all that is really showing us the largest decline that we saw in any given year. A great example of this is if we look at 2020, just a couple of years ago. And so focus on this gray bar here, that's the third to last gray bar. We see that in 2020, we ended the year up 16%. And as most of us might remember, since it was pretty recent, we know that 2020 was a very volatile year, right? We saw a 34% crash, a market crash that bottomed out in March. And so you might have looked at, if you look just at the gray bar, you would see, hey, we were up 16% at the end of the year. What a great year. And yeah, it was a good year when we look at the year-end market return. But the full picture is seen when we look at the red dot of minus 34% to see, wow, we experienced quite a bit of volatility. It gets a little bit more interesting as well when we look at and compare how frequently we see volatility on a calendar year basis and on an intra-year basis. So if we look to see on a calendar year basis, how frequently do we see these types of corrections? We see a market correction that we define as 10% or more decline about every 2 years on average, and a bear market of 19% or more every 4.5 years, and a crash of 30% or more every 12 years. When we compare that to the intra-year decline, we see even more significant numbers where this happens even more frequently. And really, like I said, that intra-year decline is a better representation of what we actually experience as investors, because we do have to go through those intra-year declines. So on an intra-year basis, if we look at just the average year, we see a decline of 14%. And if we're looking at a bear market, which we're defining as 19% or more decline, that's about every 3.5 years on average. And lastly, we see a market crash of 30% or more about every 8 years. So really the big takeaway here is to remember that by nature, equity markets are very volatile. We see volatility very frequently, it's in its nature. And that as investors, if we want to earn a higher return than just being invested in cash or the US Treasury market, the short-term US Treasury market, then we need to be okay and accept short-term volatility, because that's the only way we're going to get the long-term return. And while what's happened so far in 2022 is not fun, and it certainly was a bit unexpected, it is not unprecedented. If we look back at history, we can see similar volatility throughout past years. Now, this is true when we're talking about the US stock market, but when we talk about the US bond market, it looks a little bit different, right? And when we look at the US bond market specifically, what's happened this year is a bit unprecedented. So this chart is the exact same format as the last one that we just walked through of the US stock market. The big difference is now we're looking at the US bond market. And this is from 1976 to 2022. And so if we look at year-to-date numbers, and this data is from about a month ago, we were down 10% in the US bond market as a whole. And at some point in 2022, we were down minus 13%. So we saw a 13% intra-year decline. And it's pretty easy as you look across this chart to see, and focusing on the red number specifically, to see that we haven't seen double-digit intra-year declines like we've seen this year ever since 1976. And really the only years that become comparable are over here on the left when we look at the late 70s and early 80s. And just to remind you, that time period was when we were seeing high inflation and high interest rates. And even in that time period, we didn't quite come up to the minus 13% that we're seeing today. So all of this is just to go to say, what we've seen in the bond market this year has been unique, right? It's been different than what we've seen in the past. And the uniqueness of this year doesn't end there. If we look at a couple of different asset classes and their performance through the first 6 months of the year, then we can get some interesting historical context. So first of all, the S&P 500. And as a reminder, again, we're looking at the first 6 months of this year. So the S&P 500 over that period saw a return of minus 21.08%. If we compare that return of the S&P 500 to all other 6-month periods since 1926, then that is in the worst 3%, the worst 3% of all returns for the S&P 500. So pretty significant. When we look at 5-year government bonds this year, they're down 10.9%. And when we look at that compared to when we look at that compared to all other 6-month periods, we see that that is the second worst return since 1926. And lastly, a 60-40 portfolio. So 60% stocks, 40% bonds, down 14.51%. Looking over that same period, that's in the bottom 2% of all 60-40 returns since 1926. The last really interesting statistic on how unique this year has been is that, again, looking at since 1926, this is only the 4th time that stocks and bonds were both down in 2 consecutive quarters. So while equity market volatility should not come as a surprise, what's happened in the bond market is a surprise and is a bit unprecedented, especially in context of what's happened in relation to the bond market and the stock market at the same time. 2022 in general hasn't been easy on us, but the good part is that there's good news from here. We've seen some market declines, and when we see markets go down, we know that expected returns go up. This chart is pretty simple to look at, but it can be pretty powerful. And the data that we're looking at here is US stock market again. And even though this is going over the US stock market, it really does apply to bonds. It applies to international markets. The numbers will look different, but the concept that as markets go down, expected returns go up holds true. I want to focus on this chart in the middle section that shows return after a 20% market decline. That's pretty similar to where we're at today, right? And what we've seen so far. And when we look at that section here, we can see that the first bar shows us 1-year average cumulative return is at 22.2%. After a 20% market decline, on average, 1 year later, we would see a 22% return. After 3 years, we would see 41.1% return. And after 5 years, a cumulative return of almost 72%. And so these numbers are very significant. These look different every time, but this is what we've seen as the averages dating back to 1926 of 20% market declines. You can see the other numbers for 10% and a 30% market decline. But really the 20% market decline is most similar to what we've seen today. As an investor, what we see for investors as financial advisors is, as an investor, a significant portion of your long-term investment performance will be derived by how you handle market corrections and crashes. During this time, it's so important that we separate emotions from how we make investment decisions and what we do in our portfolio. And it's imperative that we stay disciplined to our approach in order to participate in these positive returns that have historically followed major market declines.
Thank you, James, for the historical perspective. Hi, everyone. This is Livia Thomas. And I just want to acknowledge that we certainly do appreciate the emotional impact that market downturns can have. It can feel unsettling and can leave you wondering, is this time different? A common question we hear almost weekly from clients is, how can I gain an edge? Time and time again, the data shows us that the markets look forward. Your edge is to stay consistent and disciplined with your portfolio. So I want to show you a couple of visuals of what we're talking about. I mentioned the markets look forward, and this is in fact the case with equities. Looking at this chart, the vertical line shows the annual return on assets above cash and risk-free assets. So the higher returns are plotted on the top half of the chart, and the lower market returns are plotted on the bottom half of the chart. Along the horizontal line, you see annual GDP. And as you go to the right, GDP is expanding, and going left is when the economy and GDP is actually contracting. So I want to focus your attention on the upper left quadrant of this chart. All of these dots represent years when the US economy contracted, but US stocks still outperformed less risky treasury bills and cash. So the equities market was already steps ahead of the economy in that upper left quadrant. This gives you a great visual to see how performance retreats ahead of contractions and performance advances sooner than the economy does. Now, this is really interesting. Let's take a look at some of the outliers on this chart. The red circle highlights where 4 of the best 5 years of market performance actually occurred in years with negative GDP growth. We see the inverse is true during expansionary periods. In the red circle below, 7 of the 10 worst performing years actually occurred when the economy had positive GDP growth. So we see that equities are in fact forward-looking. The best predictor of the economy is the market itself. I apologize, the best predictor of the market is the market itself. So you may be thinking, okay, that makes sense, but is the same true for bonds? And the answer is yes, the bond market also prices in information daily. This is even true in terms of recent and various rate hikes by the Fed. So in this chart, this is a 2022 year-to-date daily tracking of the 10-year Treasury. You can see it starts in the bottom left-hand corner, the blue line, and it continues kind of upward throughout the year until where it landed yesterday. So what I've done is I've plotted on this chart the various points that the Fed made the announcements when they were actually doing the rate hikes. Now, if you'll notice, or if you recall, earlier in the year in January, the Fed signaled that they would be doing rate hikes. And if you see, starting in January, the Treasury yields started to work their way upward until the point where the Fed actually announced that increase of 0.50% on March 15th. So you'll see as the Fed increases the rates, the 10-year Treasury actually follows in the same general direction. But keep in mind, interest rates don't immediately move the day following the announcement. Now let's look a little closer at that May-June period. So you'll notice the May period starts with that May 3rd increase of 0.75%. And then you'll look towards the June 14th marker in red with the 0.75% increase. Now, if you look from May to June, you'll see that the bond market was in fact pricing in the information daily, and it actually priced in the rate hikes before the Fed actually made their announcement. So if you'll notice, the 10-year Treasury continued to climb and peaked at 3.49 right before the Fed decided on that 0.75% rate hike June 14th. And then as you'll see, by early July, as expected, the 10-year Treasury declined down to 2.82%. So even with the most recent 0.75% rate hike that the Fed announced on Wednesday, the market continues to price in that information daily. So the real key point here is that both the equity and bond markets are in fact forward-looking. So now you may be thinking, okay, then it makes sense to use the equity and bond markets as a guide to know when to time the market. While the market is pricing in all of the information daily, it does not tell us in advance exactly when it will change direction and to what degree. So the next question that may come to mind is, then what is the opportunity cost of market timing, even if I just miss a tiny period of time as an investor? Now, for our existing clients who are listening, this is likely a familiar chart. For anyone joining who is new to Aspen Capital Management, I will walk you through what we're looking at here. This chart shows what would happen if you started with $1,000 in 1997 and you were evaluating being fully invested versus partially invested along this term, and shows the impact in terms of dollars. So obviously, as you move from the right side of the chart to the left and you decrease the amount of time that you're out of the market, your returns actually improve and your $1,000 grows to $10,367. Now, one of these time periods delivered 39% gains. Can you guess which period was the best one of the 4 periods represented? If you pick the period ending June 22nd, 2022, you're correct. Congratulations. Of the 300 months measured in this 25-year window, this very small period of time that represents a mere 1% of the time horizon actually provided record performance of 39%. But despite the noise and the fear during that same 3-month period, you had to be present to win, which is to say you had to stay invested to capture those premiums in the market. So essentially, timing the market leads to underperformance over the long term and truly derails progress made toward reaching your financial goals.
Great, thank you, Livia. I think we'll just pause right now and see if we have any questions. Mike, are there any questions that came through?
Yeah, I want to go through the chat bar here real quick. We had I'm going to start at the top. Hugh, you had entered a question that looks like you only typed in about half of it, something about intra-year declines. So we would encourage you to maybe retype that question in and send it to us, and just make sure you get the full question in. There was also a question about in the slides about the market recovery after market declines. The question was about, is that at the market bottom? So for example, when we come back to this slide right here, the question I think was sort of related to, is this from the market bottom, this return after a 20% market decline? And yes, it is. I think James also pointed out, these are not annualized numbers. Those are cumulative numbers off of the market bottom over that period of time. Just looking at other questions here. So there's a question here, James, on does the definition of a diversified portfolio change given unprecedented movement of the bond market?
Yeah, that's a great question. And really, the short answer to that is no. The purpose of when we're looking at having stocks and bonds in a portfolio is the stocks are there to drive the return, and the bonds are held in a portfolio to optimize the volatility and level out some of that volatility. This year certainly has been very unique, but that doesn't change the role in the portfolio that bonds have and that stocks have, for that matter. And even though this year has been a bit unprecedented, we don't have any reason to believe that that's what's going to continue for the next decade or so. And bonds, as far as our best alternative, they still are the best alternative to play that role of the optimizer. Anything that you would add from the rest of the team?
No, but there was a second question on there about intra-year declines. And does an intra-year decline include a full year? And I think maybe the best way to handle that is to describe. So an intra-year decline is defined as the peak during the year to the trough during the year. So an intra-year decline hypothetically could be a peak on February 15th to a trough, let's just say on October 1st. So no, an intra-year decline could be as short as a couple of months, like we had back in 2020 during COVID, where our peak was somewhere in about the first of somewhere in February. I don't remember, let's call it roughly mid-February, and our trough for the year was on March 23rd. So I think that's probably the sharpest peak to trough decline, certainly that I ever remember. So an intra-year decline could be as short as maybe 6 to 8 weeks, or it could be 8 to 10 months. But it is not a year. It is within the calendar year. Great. I think that's good. I think that's good on questions for now. Again, encourage the questions. Please feel free to add them to the chat component at the bottom of your screen. And with that, Katie, why don't you address some thoughts on inflation?
Great. Thanks, Mike. Good morning to some, good afternoon to others, and a very early good morning to our friends joining us all the way from Thailand. Wanted to say hi to you. Hi, everybody. This is Katie. I'm talking on inflation today. And if you've read one piece of financial news this year, it's likely you've read about inflation. In June, the consumer price index rose to 9.1% over the last 12 months. The last time inflation was this high, any guesses? November of 1981. You might remember the primary symptom of inflation is an increase in prices, and certainly prices have gone up. Now, if you happen to own a truck, like my handsome husband, we can lament over the most recent gas prices seen here on your screen. And all I can say about this is thank goodness he doesn't drive a diesel. So what does all this mean? The data we see on the news and that CPI percentage that was released earlier in June, that's all backwards looking data. We're seeing information on what has already happened. But as an investor, we need to be asking ourselves, what are prices or expectations looking forward? Markets, as Livia mentioned, are forward-looking. Let me explain. Think about the stock market. Let's use Microsoft as an example. Microsoft's stock price today is a reflection of what investors believe that Microsoft will be worth in the future. Using that same principle, there's a tool the market provides to help us understand what millions of investors believe inflation will be in the future. Treasury yields and TIPS yields are one way the market expresses its projection of longer-term inflation. And believe it or not, investors are expecting inflation to come down dramatically. What you're looking at is the one-year break-even inflation rate. The break-even inflation rate is just the difference between TIPS bonds, an investor loans money to the government and gets compensated for any changes in inflation, minus a normal T-bill. The investor is just loaning money to the government. If you subtract the two, what you have left is the market's expectation of inflation. So you can see here that markets started the year believing that inflation would be around 4%. That number jumped in March, but has since settled. What you gain from the graph is, while you're certainly experiencing inflation that is higher than 4% today, the market is predicting the average rate of inflation to be 4% over the next year. Okay, so now let's look at a longer time frame. This is the 5-year break-even rate. It's the same story. We began the year around 3%. Projections spiked in March, but by the end of June, markets' expectations of inflation cooled back down to around 2.5%. Because we're talking about a 5-year time frame versus a 1-year time frame, you can see that average is driven down. And over the next 5 years, the market is predicting an average of 2.5% inflation, which is what we're planning for in your financial plan. Interesting, right? So investors see this data and they're pricing it in other places. So let's take a look at commodities, because I think this is an interesting story. Commodity pricing is known as a potential leading indicator for inflation. If you think about that, that actually makes sense. The public price of commodities is much more likely to reflect prices based on real-time information than what you might eventually see at your local grocery store. So let's look at some commodities data from last quarter. So again, this is second quarter data, 2022, second quarter data. You can see over here, commodities were actually down a negative 5.66% on the quarter. And some interesting categories over here. You can see that live cattle was down over 4.5%. Corn was down almost 11%. Wheat was down negative 14%. And lumber was down over 30% last quarter alone. You might even see it at those gas prices we talked about earlier. Those are dropping as well. In the last 2 weeks, our team has noticed gas to be down in Boise around 15%. So remember, these are all just indicators. We can't be sure what will happen with inflation, but we can use market data to help inform our thoughts for future. And now that you've seen some forward-looking data, what can you actually do about inflation? Well, we would suggest that you think about taking action in 2 ways. Number one, you can plan for it. Your financial plan becomes an integral part of your overall financial success. Inflation is very personal. That 9.1% is a statistic that's derived from over 80,000 prices of goods and services. Not all of those items will make a difference to you. So try and put that 9.1 in context with your own spending. If your household spending has gone up for the year, think about recalibrating your annual spending goal to show the new prices set by the large increase in inflation. Remember, we're planning for 2.5% inflation over the long term, but you actually might need to go and take action and reset your base amount. You can go into your financial plan and change this number to see what impact it has on your overall probability of success. If you have any questions about how to do this, or you can't log into your financial plan, please reach out to your financial advisor to help you through that. So that's one way that you can take action for inflation. The second way, or number two, is you can outpace it. On your screen, you're looking at a chart that is showing the percentage change of the S&P 500 versus inflation. The green bar is representing equities, and the red line represents inflation. 2 major takeaways here. Number one, inflation and equity returns are not related. In any one year, you have years of higher inflation and negative returns. You also have years of low inflation with negative returns and years of low inflation with positive returns. There's no pattern here. Equity markets cannot be timed with the rise and fall of inflation. Number two, over the long term, the return of equities has far exceeded the percentage of inflation year over year. Take a step back, look at this graph as a whole. You can see those green bars represented for equities have far exceeded the pace of inflation in the past. And this is a really important lesson. Many investors mistakenly identify volatile equity markets as their biggest risk factor. However, that stubborn monster of high inflation year after year, eroding your purchasing power, can be an even bigger risk, especially in your retirement years. So while it's important to make sure your asset allocation is appropriately aligned for your risk tolerance, it is also important to take on enough equity risk to keep up with or outpace inflation over the long term. Our team at Aspen Capital Management is helping you weather the storm by making sure your asset allocation is appropriate for you We're working in your financial plan to make sure you're properly prepared for inflation. And as you've likely grown accustomed to hearing, we're researching and using evidence to inform instead of using emotions as a tool for making investment decisions. We're staying disciplined to our investment philosophy. So Mike will be diving deeper into performance here in a second, but quickly on your screen, I want to end with some interesting final data. This is highlighting the average annual real return. Now remember, real return is market returns minus inflation in years with above median US inflation. You can see equities in general perform much better than bonds. And good news for you and your portfolio, small cap value stocks have historically outperformed by a landslide in times of above average inflation. So Mike will go into this in more detail and highlight how this principle has remained true for you, and you've taken advantage of this outperformance in your own portfolio. Mike.
Thanks, Katie. So after really nice returns in 2020 and 2021, Mr. Market has decided he wants some of his gains back. So what you're looking at here is returns through yesterday's market close for the major asset classes that both our clients invest in, and I would say most investors invest in. And the first thing, of course, you'll notice is that every bar is red. Every major asset class is negative year to date through yesterday's close. This has really been one of those rare years where there's been nowhere to hide. Regardless of the risk someone's taking, they've had negative returns. On the far left, you'll see bonds are down about 9% year to date. If you're looking at the aggregate bond market, high yield bonds are down more, but we don't tend to own high yield bonds. As you look at the middle of the chart, you see US equities as well as US small cap value equities down 10 to 16%. And then as you let your eye go to the right, you'll see the international and emerging markets are down 17, 18%. And finally, on the far right, global real estate is down about 16%. Now, we figured if you're on this webinar, you likely follow markets close enough to know that everything is negative this year. So what we thought we would do is take a deeper dive into recent equity returns and really give you a deeper understanding of how the returns in global equity markets have changed over the last 3 years. So it's important to start this discussion by reminding you of what you own in your stock funds. You own the whole of the market. Okay, so you own both growth and value stocks, but you might remember that you're underweight growth stocks versus their market cap weight, and you're overweight value stocks versus their market cap weight. You also might remember that we do this because 100 years of market history suggests that over the long term, we expect value stocks to outperform growth stocks. However, in any short period, the opposite can be true. Now, what we're graphing for you here, just to walk you through this, is we're graphing for you the spread or the difference between the valuation of growth stocks versus value stocks. So I'm going to start at the bottom of this graph in this light gray line at the bottom. This is the historic price to book ratio, which is a very common valuation metric. And this light green bar or light gray bar at the bottom is graphing the historic price to book market of value stocks. At the top, the dark gray line is graphing the exact same valuation metric for growth stocks. And so the number that's most interesting here and the line that's most interesting is the blue line. And that blue line represents the spread or the difference of growth stock valuations minus value stock valuations. And you'll see that at the end of 2020, we ended the year at a point where the difference in valuation between growth stocks and value stocks was the highest it had been in US market history. Now, many of you may remember at the end of both 19 and 20, some of the equity funds you own had underperformed their benchmark. And we explained to you at this time that this was due to a historically unprecedented rise in the valuation of growth stocks. Certainly, you could see that on this chart. And as a result, growth stocks had outperformed value stocks, especially in that 2019 and 2020 years. And we ended 2020, as I said, with the widest spread in valuations ever. And our guidance to you at the time was to be patient, because we knew that these growth stocks were very expensive versus their historic averages, and that they were highly unlikely to outperform forever. And then in November of 2020, it all changed. And we saw one of the sharpest changes in performance in history as value stocks began what has been a 20-month period of substantial outperformance versus growth stocks. And I wanted to actually just walk you through that and attach some data to that. So we're going to start here by dissecting US equity returns over the last roughly 3-year period. Okay, we'll start at the top here with large cap equities. And I want to show you that we're breaking this down into 2 distinct time periods. The first is that period from the beginning of January of 2019 through November 1st of 2020. Again, November 1st being that day where we really saw a wholesale change in how the market was valuing stocks. Then the second time period on the right is from November 1st of 2020 through the end of the second quarter of this year, or June 30th of 2022. So you'll see that the markets performed reasonably well. By the way, these are not annualized returns. These are going to be gross returns or cumulative returns for that time period. And you'll see that the S&P 500 index performed quite nicely during both of those time periods. But when we break that down and we look at just the US large cap growth index, you'll see that in that time period leading up to November of 2020, growth stocks just had an incredible run, literally historically an unprecedented run. And they've effectively been nearly flat since then. Value stocks have been almost exactly the opposite, really underperforming in that period leading up to November of 2020, and then noticeably outperforming since then. So you could really see that rotation from growth to value. And then as we go down and look at small cap, we see exactly the same thing happen. The market in general, the small cap market in general, has performed just fine. But here you see that stark difference between growth and value is even sharper. As value stocks were very nicely positive leading up to November of 2020 and then have been negative since then, exactly the opposite is true in value stocks. Small cap value stocks have been on a tear since November of 2020, while they were negative in the period leading up to then. So a couple of things to just point out. Again, this rotation from growth to value, we have not seen a period of rotation this swift since the tech market crash of 2000. And then finally, I would say we're using the US market here today as an example for you, but this rotation has been exactly the same in international and emerging markets. Now, a question many of our clients ask us is, well, then how have the funds that we own, how have they performed? Right? Our funds are tilted towards these value stocks. So how have they performed during this period of value outperformance? So again, we're going to look at US large and US small cap stocks, and we're going to look at the funds you own, their performance versus their benchmark index. And again, we're going to focus on this time period from November of 2020 through the end of the second quarter. If we look at US large cap value stocks, you'll see that the fund that we tend to own has outperformed its value benchmark index by about 6 percentage points over that roughly 20-month period. And then if we look at US small cap value stocks, you see an even wider period of outperformance. The fund that our clients own has actually outperformed its small cap value benchmark index by about 19 percentage points over the last 20 months. So while returns have been negative year to date, you've substantially outperformed the benchmark indexes since the growth to value rotation began in November of 2020. Now, a few key takeaways that we want to make sure you leave this with is, just as you've seen, we know value stocks will have periods of outperformance and underperformance in the short term. We're long-term investors, and the data is clear that over the long term, these tilts in your portfolio add value. Second point is when the value premium is positive, right, and value stocks are outperforming growth stocks, your funds are fully capturing the premium. Now, we also want to make sure you understand that outperformance on this scale is highly unusual. So we mentioned the small cap value fund is outperformed by 19 percentage points over only a 20-month period. That is highly unusual. Over the long term, we're expecting outperformance versus the benchmark index of about 3/4 percentage point per year for equity funds. And then finally, each one of the core equity funds that we own has outperformed its benchmark index since the fund's inception. Again, focusing on those long-term returns. Now, the question we often get is, this is great, but where do we go from here? So if we come back and take a look at our valuation screen, right, the same data we were looking at before, but we extend it from the end of 2020 out to May of 22, you will see as value stocks have meaningfully outperformed growth stocks, that blue line has come down, right? That spread between value and growth stocks has definitely come down. You will see now that that spread is back to its peak levels in 2000 during the tech market, the tech market bubble. So growth stocks remain at what had previously been their widest valuation spread in history versus value stocks back to that tech bubble of 2000. And while we don't predict markets, at least by historic standards, value stocks still look cheap versus growth stocks. So we remain happy to own portfolios that are overweight value companies versus their market cap weight. And just to put a bow on today's discussion, there's a handful of points that we want to make sure you walk away from here. We've given you a lot of data today to consider, but let's just summarize on sort of 5 key points we want you to walk away with. First of all is the market declines in both the stock and bond markets have increased future expected returns for both of those asset classes. The second is markets are forward-looking, and current prices include all available information. And as Livia pointed out to you, equity markets always have recovered well before the economy does, right? And bond markets price in forward-looking interest rate increases today, right? So those prices, interest rates will price in those rate hikes before the Fed actually raises rates. As Katie mentioned to you, one of the best things you can do to fight inflation over the long term is outpace it. And the 2 important things that you can do there is continue to be an owner of equities and real estate. Finally, versus the conversations we had in 2019 and 2020, value stocks are back in favor, and your funds are fully participating in values outperformance versus growth stocks. And then Katie made a great point. which is years like 2022, which have not been good from a return standpoint, should always be viewed from the lens of your financial plan. We know we'll experience short-term volatility. Clients that have been with us for years have had many periods like this. And we think it's always important to look at these short-term volatile periods through the lens of your long-term financial plan. And with that being said, we thought this picture that our team captured a few months ago during the Queen's Jubilee is maybe the best depiction of how we would like you to act as an investor. So here you've got the Queen and her grandson, and they're at the same event, right? They're having the exact same experience with things that are going on around them in their environment, but they're acting completely differently, right? And we suppose that the grandson on the right is probably similar to your friends, right? Your friends, your neighbors, your co-workers, again, experiencing the exact same market environment. Your friends are being completely overwhelmed by all of the information that's coming at them and all of the happenings, if you will, in their environment. Inflation, the bear market, war in Ukraine, rising house prices, rising interest rates, completely driving them crazy. Now, we're hopeful that you are much more like the Queen. Again, same market environment, same environmental factors affecting your portfolio and inflation and your financial plan. But we're hopeful that you are acting like the Queen, right? You're standing there, you're a patient long-term investor, you know that your financial plan is in decent shape, and your complete focus is on keep calm and carry on. So with that, I want to come back to questions. If you haven't yet and you've got a question on your mind, please take a second and enter it in the chat bar. One that did come up is if we could describe the difference between growth and value stocks. That's a great question. Growth stocks, the best thing I can do is maybe give you some examples. We would consider a growth stock to be, today they tend to be the large cap tech companies. So names that you might find familiar would be names like Tesla, Netflix, Facebook, Amazon. Those would be just to name a few. They tend to be rapid growth, large cap tech stocks. Value stocks, on the other hand, if you think about what's really driven the outperformance the last 20 months, I would think about maybe three different categories. One would be banks. Okay, so JP Morgan would be a great example of a large holding and a value-oriented portfolio. Energy companies, and especially big oil, right? If you go back 20 months ago, before oil's big rise, you saw companies like Shell or ExxonMobil were characterized as big value stocks. And then the third would be pharmaceutical companies. So a Merck, a Pfizer, a J&J, those would be companies that would have been 2 years ago and still today considered value stocks. I see we've got a couple more questions here. So the question here is, markets are forward looking based on what? I'll kind of open this up to the team. I'll maybe take a first pass at it. But markets, let's take equity markets just as an example, and let's kind of narrow it down there. So if you think about an equity price, right, the market prices equities. Today's price for any equity is really the cumulative expectation of its future profits, right? So it's forward looking in that the market is projecting forward what it believes the future profits of that company will be. And the example I will give you on this that I think really kind of drives this point home, and I think it helps you understand how the markets tend to overreact from time to time. If you go back to March of 2020 and you look at how many stocks prices had been beat up, right? The market was pricing in a far greater decline, future decline in those profits than was probably reasonable, right? Those companies' profits were going to have to decline massively for those prices that we saw in late March of 2020 to make sense. So as soon as the market realized that in April and May of 2020, that those companies' profits were not going to be hurt nearly as badly as was expected, those stock prices rose dramatically and very quickly, long before employment got better or the actual economy got better. Anybody else want to take another cut at that? I don't get any takers. I don't get any takers. So with that, I will say, just to follow up on that comment, I thought that the slide that Lavia shared, if you take one thing away from our presentation today, we gave you a lot of data. I think one slide that to me is the most powerful of them all is really looking at these two charts. And that is understanding how forward-looking markets are, right? Lavia shared with you, if you look at 4 out of the 5 best performing years in the US equity markets have come when the economy is contracting and we've actually had negative GDP growth. And then on the flip side of that coin, when you look at some of the very worst years in market history, right? If you look at the 10 worst years in US equity market history, in 7 of those 10 years, we had those horrible years of market returns when the economy was actually growing, right? And that is the market pricing in the future ahead of it actually happening. So with that, I think we've got a wrap on things today. I don't see any other questions. So we want to thank you for joining us today. If you had any questions or anything comes to you in the next day or weeks, feel free to reach out to your advisor. We've been having great discussions with clients on these topics. We love discussing it. And so just reach out to us and we'll be happy to schedule some time to talk.